Is it like more like spray and pray?
It was a game of law of numbers, right? Most of the time, venture looks at disruptive innovation. Yeah, the number's actually gone up to 63 now.
New York Times Weekly, celebrated you as 40 under 40. How was
Show me that if I have $1 million in my pocket, which I can't wipe you out of the market tomorrow.
Have you seen Shark Tank? Now, Shark Tank India is the perfect example of how Indian ecosystem in startup is booming. Now, you can be part of it too. Welcome to Staying Indian, the NRI podcast. And to explain angel investing, VC investing, and the difference between Shark Tank and these two, I have someone very special. I have Anmol Goel. Anmol Goel is the youngest VC I know who has 54 million plus funds under management. And he has been, from the humble beginning of Dani, he has been trailblazing all over the globe and investing into startups. And we'll know more about him and about his thesis. Welcome on.
Thank you very much, Gaurav, for having me. Really appreciate being here.
So, right at the start, I want to ask you, what is VC investing?
Yeah, I mean, VC investing as in, if I try to explain it in layman's term, when we go back to where VC started it was a game of law of numbers, right? So law of power, also sort of, you can be depicted upon that. You invest in 100 companies and you're betting that your 2 or 3 of them are going to be mega superstars. Where it differs from angel investing, your mom and pops investing is they will come in and they will say, I'm banking, 30-40% on this company, and I'm going to make this a hospitality company or nails shop or whatever grow, and I'm going to put my time and sweat and everything else into it. The traditional way the VC game sort of started was, I see a lot of potential in a certain area, and I'm going to be expert in that area, and I'm going to try and drive innovation through. And I'm going to drive innovation through backing as many companies that I can, and the ones that are doing well, I'm going to keep putting more and more money into it. And the prime example of it is something like a YC, right? Where some people like it, some people dislike it, depending on where you sort of sit on that bridge. But YC, for example, has done about 2,600 or 2,700 investments, right? And when you look at their DPI in terms of what has returned them, their most of the money back, I think the overall YC fund sits around 1.7 or 1.8x. Out of 27 or 2,600, there's been 3 companies which have resulted in 50% of all the money they've gained back, right? So it's really betting on these big numbers and betting on anomalies in the industry, right? And anomalies by nature aren't supposed to be very predictable. So what's the best idea? You have a certain foundation or a certain sort of bandwidth where you say between this to this is what I'm going to look at. And as the curve turns, I'm going to put in more and more and more and more cash into those remaining ones, and the rest will sort of die out. And over time, I should see power law sort of kick in and the top ones sort of take over and my portfolio having a good return. So that's in layman's term what VC investing has been. Right now it's shifting, with Speed Invest and recent and a lot of recent guys sort of making a switch, and a lot of people saying VC game is dead. Happy to obviously touch a bit more on that, but yeah.
Wow, nice. I think it's a very good explanation. And is it like more like spring pay? And before you answer that, I want to clear that if people don't know what YC is a YC Combinator. It's one of the largest investment firms out there. Is it like more like spray and pray?
I see. I wouldn't call it spray and pray. To a certain extent, you're still trying to do your due diligence as much as you can. But in the early sort of stage, super early stage, you're almost banking on the founders, right? And the innovation that you think that team is particularly capable of. So I think rather than spray and pray, it's more taking aggressive bets. VC by its nature is meant to be disruptive. right? It's meant to be backing the newest of the newest, craziest of the craziest. And when you're backing that kind of stuff in the super early stage where, they're pre-revenue, there's no sort of cohesive data in terms of what they're doing and how things are going to look like in 2 years' time. Remember, with PE, right, you have, 6-7 years of cash flow, you have EBITDA margin, you have complete analysis on how the company's been performing, the team. But if you're comparing, 3 guys, working out of their rooms and building something interesting and having, something break through that they've done over the last 5-6 months, well, how do you really judge that? Right. So potential on it is sort of extrapolated depending on a few factors of the individual's past and the technology itself. So I would say more so than spray and pray, because I think it gets a bit of a bad term. It's taking educated bets which are still risk heavy, right? So VCs like to go with this term of 100x, right? Especially in the US and in the European side, where we're based. I mean, I'm London, you're Amsterdam, right? It's a bit more sort of risk averse, right? That they almost merge the PE mentality with the VC concept, and hence why we don't see as many breakthrough stars in the UK, US, or UK European market. But in the US, it's this whole idea of 100x, right? And in order to chase the 100x, you got to let a lot of 2x, 3x, 5x burn, right? To be able to ensure that 100x comes through.
I think that truly makes sense to me. For our audience, can you describe what PE is and what do you mean by PE versus 2x, 100x?
Yeah. So PE in the traditional sense, private equity, right? That's when companies most of the time either get completely acquired or private, large partial acquisition, where these are bigger companies, these are cash flow generating companies. Venture most of the time, right? So I'm talking about 90%. There are obviously different strands of venture now which look at the very old school stuff as well, but most of the time venture looks at disruptive innovation. So you won't get ice cream shops or a hair salon or a burger place in a venture. Like a VC won't be investing in that, right? Because these are very traditional businesses. But a private equity company, given that a business is making solid revenue and had solid EBITDA, they will acquire these kind of companies. Actually, there's massive private equity funds whose focus is literally to buy out very boring, very non-sexy businesses, but they're very good cash flow generations, right? They're making $5 to $10 million a year. Maybe it's a cohort of 5 to 6 laundry companies across, West Coast or East Coast, whatever. They're doing good money, but they now don't know where to go next. Or, the guys have been operating it and their kids don't want to do it. And they come in and acquire it. So the whole private equity model is shorter time horizon. One, it's largely developed companies. And it's to basically keep cash flows constantly going. That's the PE model. So that's where you'll expect, your 3 maybe to up to 10x in PE. Whereas venture is a lot more early stage, give or take about 10 years time horizon, because you're looking at companies who are pretty much no value on paper, right? Like the sort of the example that I gave regarding, there's 3 kids working out of their sort of mom's basement or whatever, right? And building this technology, and they might be onto something, or sort of like a university accelerator. How do you value that, right? On paper, you can give out a safe note and say we are worth 5 million, but in actuality, what sort of, ascertains that value? It's pretty much nothing. Whereas in private equity, these companies have value on their balance sheet. They have been operational. And now the thought process very much is, do we then take this company and grow it by 30 to 40% and just keep the cash flow going? Or it's a strategic acquisition in parts of adding it to their existing portfolio. So private equity is a bit more wealth generation has been done, now preservation and integration, whereas VC is a bit more focused on generation, the wealth generation part of really sort of hitting it out of the park and getting that home run.
Well, it sounds boring in theory, but in practical, it is very exciting. I can tell you that from my personal experience. I started angel investing, then I moved on, and I'm working with Riceberg VC. And yeah, it's like, finding out those kind of unicorns is the exciting game that you are in, right? And we'll get up to that. But I want to know about you first. A bit about how did you got at such young stage? If I talk to a VC, he must be like 50 plus, or having worked in certain industry for years, and then learned, and then knows how to actually find that company which will grow like 100x. But you are just 24, 25, I guess.
Yeah, 24. Yeah.
Yeah, 24. See, so tell me a bit about how I was growing up in Delhi, and then what brought you to UK, and especially what dwelled you into VC investments.
Yeah. No, so I think India was a complete different sort of shift. So I moved to the UK when I was 10 years old. So before that, growing up in Delhi, it was relatively humble beginnings. The thing as a low middle class Indian family was just study, right? So parents worked tremendously hard day and night to sort of make ends meet. And my thing was always growing up, even sort of getting to the age of 8 to 10 was just like money's everything, and I sort of realized that at a very young age. How the UK shift happened, funny thing. So I was about 8 years old when my dad moved to the UK, and so he used to work in packaging and pharma sales, right? And he had a trip to and I don't know what his position was at 8 years old. I would no clue. I just knew that did that, right? That was the only thing that I knew. And he had to come to UK to maybe a conference or selling something. I can't remember exactly, right? For a week, and then the week goes by, and he rings mum. He's like, "I'm not coming back." She's like, "What the hell do you mean you're not coming back?" He's like, "I'm not coming back." He's like, "I'm going to stay here. I'm going to build, I'm going to work, and I'm going to make sure, I can give, our kids and family a better life." So then it was me, mum, my brother, and my nan, sort of alone for the next year and a half in Delhi. And I really had to grow up really quick, right? Because Delhi is not for beginners, right? And as an 8-year-old boy who had to sort of try and look after not per se like I had to start working at 8, but I had to start growing up super quickly because dad wasn't around anymore. I mean, he would obviously send money and everything, but that perspective changes very quickly, right? And you start seeing the shift, and mum had to work super hard. And then we came to the UK, and the thing was then, if I can just do a little bit for mum and dad, right? If I could just earn a little bit more money, everything would be worth it, right? So really grew up with that mindset. And the investment journey. So initially, I didn't even know what the hell VC was. The initial sort of investment and this side of journey started when I was about 15 years old. Like I was always doing sort of work. I used to cut grass. I worked at Primark. I did tutoring. I did accommodation tours. Like you name it, I've done it. Right. And around that time, I remember watching Wolf of Wall Street. And that was my first introduction to sort of investment banking and the sort of the city lifestyle, like they call it. And I was like, just mesmerized by, wow, okay, this is what, this is how you make money. Because all we knew, and I'm sure you can relate as well, that Indian families of like, what you study, you become a lawyer, doctor, engineer. And then, this other avenue that I saw was investment banking. I was like, okay, I want to go into that. But I was always very, just hands-on, and I wanted to build and do something. So when I got to university, I built my first startup at 18, which was a fintech company. So I'd gotten into crypto and trading very, very early on. And I was able to sort of build out indicators and signals, which I sort of started to use and sell, and had like small hedge funds sort of come in and getting plugins. That ultimately didn't end up working out because of COVID. I didn't have enough, I guess, protection around sort of black swan events. Black swan events, for those who don't know, is like, that's a one-off event which happens every, decade or whatever, and just completely shifts the market, or the market completely crashes in one day. And my indicators weren't ready for that. Then I built my second startup in my second year of university, age sort of 19, 20, which was a prop tech company, where the main thing, so in the UK there's a website called gov.uk which you can use to look at what the average price of a house is per square foot in a certain postcode. And there's two apps that we mainly use here called Rightmove and Zoopla, which to the US equivalent would be Zillow. And I created this sort of a scraper AI. So I was studying maths, so I was good at coding, which would look at in a particular area, which properties are 30% or below market value for their given postcode. Right. And I was too young to buy a property myself. So I would find these deals, I would package it up and I would sell it to brokers or sell it to, middlemen, and I would take 1%, the purchase price. If the purchase price was 200K, I'd get $2,000. And then I went into actually investment banking, went into JP at the age of 20 and realized investment banking wasn't what Wolf of Wall Street promised me. And, the facade, I was so heartbroken. I was like, I've been sold lies all my life. I can't believe it. And then, I went into wealth management because people were like, actually, wealth management is the way to go. So I went into Marsh McLennan, but somewhere I in the back, I kept sort of building stuff, trying stuff, couple things worked, couple didn't. And at that time I was like, let me, now that I've been on the founder side myself, partially had a little bit of an exit, had a failure. I've also been on JP side and know what the advisory and construction of a deal look like. Let me see if there's other founders out there who are, for example, I knew 20, if someone knows 19 and wants to know a little bit from me. So I created this venture consulting where I started advising and working with very early founders. And at the same time started being very hands-on, very, in events as well, where I would go and attend, and started meeting angels who were like, dude, I've got a spare, 15, 20 grand, right? Let me know if you know any good startups, and started helping them allocate. And as that grew, from 1 to 2 to 5, 10, whatever, and I started making money, I was like, why am I just giving away all the good deals? I need to invest. So I still remember my first angel check was $2,000. All right. And I started doing that myself. And then that led into the venture studio. And then that led into, working with angels to NRIs to family offices, and then eventually, the fund. So that was the sort of the journey. And I think in terms of, the relative young age, I think I get asked that more than anything. If I say, if I had a penny for every time I got asked that question, I think I'd be able to set up a new fund with that. I think that should be my line. But I think the biggest thing with me was curiosity. And then the second part of that was just relentlessness. I was so curious how these things were working, and I very much wanted to be a part of it. And it just wouldn't let me sleep at night. I would just constantly think about it. And I was like, I need to do more. I need to speak to him. I need to speak to her. I haven't done this, but what about this? If we look at it from this perspective. That's why when I launched my venture studio, it was such a unique model that ended up being featured on the NYC Journal and CNN and that kind of stuff, because people weren't thinking from that perspective, and I just was going all in. Like, I remember there was a phase in my life I was doing about 20 hours a day every single day for about 6 months, 20 to 21 hours, right? I was quitting corporate at 23. I was doing my 9 to 5, waking up at 8, coming back at 6 p.m. And then I enrolled into a diploma at Harvard, HBS online. So I was doing my diploma at Harvard. So that I would do from 6 p.m. then to 10 p.m. and I would get fresh, have some dinner. And then from 11 p.m. to about 4 a.m.-ish, 3 a.m., I would do my research. I would contact all the US guys, on Reddit, on all the other sort of LinkedIns, and try and have calls and have meetings and try and understand what I need to do. And, any clients that I had onboarded would work with them, and I would go to bed around 4:30, and would wake back up at 8, right? And I did that for 6 months. And the only way to do that is to just have that fire burning so badly that it doesn't let you, there's nothing else that was on my mind. This is all that I wanted. And I could, as I started seeing my progress and started seeing the results and the validation and the attraction and the applause from others, the hustle just became even more addicting.
Yeah, I can totally relate to it. There are a lot of parallels while you narrate your story. I can go back in time and I can feel myself. But yeah, it's about you. So, well, it may sound like it's easy, but I know working like 20 hours and doing what you did or what you are doing is not easy. And what you're doing is out of 30 days, you are in 12 different countries. If I understand correctly, I see you in all the events, be it in US, be it in Asia, be it in Africa. So tell me how your schedule looks like, how you are managing flying every other day.
Oh, dude, I think even I don't know what my schedule looks like. I just take it day by day. I remember having this chat with my PA, and then she had a breakdown. I was like, Sissy, what's going on? And she was like, I can't manage your calendar, right? Start of the week, I was in London, so she was scheduling for that. Midweek, I was in US, and towards the end of the week, I was in Dubai. And she was like, well, I tried to schedule a call for 10 p.m., but then I realized that you'll be 11 hours difference the next day. But then, and she knows me that I'm happy to do a call at 11 p.m. She was like, but then 11 p.m. means these people can't do it. And then when you went back to Dubai, then that meant this was, and she's like, I can't do it. And I was like, I'm so sorry. I'm like, the sort of pressure is now getting into others. But yeah, no, it's absolute chaos. But I love it. I think thriving in chaos is sort of just become part of what I do. And I think I'm really, really lucky that all these guys in the events think that it's worthwhile to have me and get me to speak and be part of their events and sort of engage with me and get me up there. But yeah, I think I'm still very old school way of business, that I want to go meet people, shake their hands, look them eye to eye, and then do business. And I think that's been a massive sort of superpower of what's been my story to success. I'm not shy of showing them I will make the trip and I'll make the effort, because often what happens, Gaurav, is there'll be many people who have the same sort of skill level or 1920, right? That there's not much to sort of go by them. But it's the work ethic, and it's the sort of the person that they will bank the business on, right? In business, we often say, I will any day of the week work with the right person, right? Even if he doesn't sort of align exactly, because I know relationship in this is a lot more important than just numbers, right? You don't want to just work with robots who, from whenever they get the next chance of something bigger and better, they'll just cut you out. Right. So I think that's massively been my sort of key to success. And yeah, right now I'm doing about, like you said, 10 to 12 flights a month, which is taking me anywhere between Singapore, India, UAE, Riyadh, Madrid, London, UK in general, to East Coast, West Coast. So it's super exciting, but super exhausting. But I'm thinking in the way that I know if I keep this up for another 2 to 3 years, my kids and my kids' kids will never have to worry about money again. I know I'm on that path. I see it right happen from the last year, and I can see where the bridge is sort of ending up. So it's like, and enjoy it, right? I think I get to travel the whole world in my age and speak in front of massive crowds, and crowds of 10 5 to 10,000 people events where I'm on the stage and they're listening to me, and people are flying me out and paying for my hotel. So I think it's a very blessed situation as well.
Indeed. And yeah, I mean, kudos to you to being able to do that. And when you're that young, you have time and energy to fly like whenever you want. But yeah, it's good. And I also read that you help NRIs or HNIs across the globe to find a bridge between startup ecosystem in India, which is kind of really brewing up. What is your fundamentals around how NRIs or HNIs should look at startup investing in India, and especially in a market where you can see the depreciation of Indian rupees, where we sit at it's around 116 per pound or maybe 100 per euro. So how do you see this market?
Yeah, absolutely. I think, my focus has been very much to back Indians. And I see that as a growing trend, and I think this will continue too. So, part of the reason, when I was mentioning we had the venture studio and started working with family offices and then something in the middle, my middle thing was I didn't want to create a cookie cutter VC where I was like, hey guys, I'm another VC who's doing B2B software and AI startups, right? Because all the LPs will say, well, there's guys who have been in the industry longer than I've been born, right? Why should we back you? So my thing was, how do I stand out, right? And again, this goes back to starting and focusing on people, the execution, the team, rather than the product itself. You know, when you look at stuff like the Uber or DoorDash, right? You don't go, wow, what an amazing idea. I could never think of it. No, it's a pretty cool idea, but wow, what an amazing team, right? Uber wasn't the first company to think about a car marketplace, right? Bridging the gap. It was the fifth or the sixth. It was a team behind it that led to it. So that was sort of my thing. And when I sort of looked at which group or which cohort of people really sort of stand out, this was the Indian diaspora, right? When you look in the West, right, especially in UK, US, when you look at who's, number one in education, right? So the statistic is 38% of UK, US population on average have a bachelor's degree, whereas the Indian diaspora there has 81% of them have bachelor's degrees. So we're much more educated, right? The second thing is average salary, right? Average household income. The average salary, again, UK, US, is around sort of $40,000. Whereas the Indian diaspora, the average salary that we're banking in UK, US, is close to about $80,000, like 78 something. So we're twice as much. And then you also look at, CEOs, right? Microsoft, Google, YouTube, FedEx, Perplexity, right? There's tons more, right? I can go on for days, who are all of Indian origin. And then lastly, this was the report that I did, which got picked up by South Asian Herald and now Forbes as well, is in the last 15 years, there's been 181 unicorn founders of Indian descent or Indian origin in UK and US alone, making up almost 20% of all unicorns, whereas the population of the Indian diaspora is only 2%, right? So I think if NRIs in India are looking where to park their money, I think it's parking in Indians who are building outside of India as well. I think the Indian market is great, right? And I think the market will do really, really well. We have a very young population, right? I think 26.4 is the average age in the country. So I think over the next 2 decades, we have immense prosperity to come, given that, Modi ji and whoever sort of comes after him is able to sustain that innovation pathway and foreign direct investments continue to sort of pool in. But this talent of Indians who are building outside of India, I think that's the where I see it, right? This is just, again, my 2 cents, is where the real scope of gold is, right? Because these guys are building with the same mindset, the same sort of conservative mindset of like, right, I need to be cash constrained, but now I have the resources of the West, right? I have the education and the mindset of Indian, but then the capacity and the zone around me of the West, which is, I think, a massive combination going in together. And I think this should be pushed even more because it benefits both parts, right? As a British Indian, I'm growing the British economy by, building here, but then I'm also, every Indian that builds, they have some set of companies, subset, back-end offices, whatever, in India as well. So they're growing that part as well. Right. So rather than it being a either or, like, we only invest in India, we only doing this, by backing this diaspora sort of equation, you're growing both markets, from the government point of view and from a founder and a sort of a gold mine point of view, you're backing the founder who has the best possible chance of getting to that $1 billion. So I think that's my sort of 2 cents. And that's the sort of the advice I would give, a lot of the guys who are currently now worried about inflation and they want to de-risk towards the venture side. I mean, again, with all caution, venture is very risky, right? It's not like your bonds or mutual funds, tomorrow if you're like, I need the money, I'll take it out. It doesn't work like that. You have to hold it. But, if you want to back risky assets and you have that ability to understand, tech itself, then maybe this is an area you should have a look at.
Yeah, definitely. I was the other day talking to Emma Rangaswamy, the founder of Indiaspora, which is one of the largest community of Indians, and he was also striking the similar points. That we have the ability to be Indian, like we know how to do jugaad, and we know how things work, and we can do it in a cash crunch way. But at the same time, we have the understanding of the global markets, of the global problems, and solving it with the very Indianness. So I think the message resonates. But yeah, we will talk about two things. We'll talk about how do you raise money, and then how do you invest it. So first of all, how have you raised $54 million funds?
Yeah, the number's actually gone up to 63 now. Okay, so yeah, I think when we initially met in Feb, so Feb to now, in the last 4 months, got to 63 million. So initially, it's like an onion layer, right? Initially, you got to start with the people who are around you, right? So this was my professional network, and then it started being the guys that I could meet very much in these events and then get them to sort of trust me, right? So it started with the initial layer where the constriction was who knows me directly and who can I meet at arm's length. As then that grows, right, and you become successful and people are like, show me what you've done and where's the proof, you can then start, scoping and throwing the net a bit more further out and say, here's what is possible, here's the numbers behind it, here's how much I've put in, here's how much this startup raised, here's why the startup is doing well, and here's the next one that will do well, right? And then you can start reaching out to people who might be like plus ones, right? You then leverage your network. You say, cool, Mr. Angel, I know you invested 50 grand, 100 grand, whatever, 200 grand with me. Now, who else do you know? And I think actually in a lot of the cases, you don't even need to tell them. They'll come and say, hey, actually, I have so-and-so who also has some money, right? So I think the core fundamental thing for me was always make sure I'm doing very, very heavy due diligence. So the value which I provide to these investors is incremental. And then that then leads to, you being able to access their network, which then, is always a lot easier because you're not having to sell to them. The guy in the middle, the trusted source for both of you, is doing the selling for you because you say, where's the proof? Well, here's just look at your friend, right? There's the proof in the pudding. And then, you start to sort of get recognized a bit more on the national, international level. You start being invited. That's when, you start making the LinkedIn post. Other people start making posts about you. You get awards, publications. I think I've got 8 or 9 international awards now. I've been in, again, sort of 7 or 8 international publications from, New York Weekly to TEDx to, CNN to Waze Magazine and that kind of stuff, right? And then that talks for itself. Then people start coming to you and say, hey, I know you have deals. We want part of it. Right. And then you sort of start leveraging that more and more and more. And at that point, you need to start to understand how, where do I actually, so now I have buckets of capital. How do I be very strategic with this? So at every sort of stage, you need to play it differently and look at what constraints do you have and what availability do you have and how do you make that work the best. But never forget, don't take shortcuts. Don't be like, oh, okay, this person really quickly trusting me. Oh, this startup is going to give me like 5-10%, whatever. I'm going to make money out of this and I'm going to do it. Right. When you start being, deceitful to the game, I think that's when everything gets ruined for you. And it has been for so many people. Right. So I would always say, take a less cut, if you have to, but try and really bring value and just think from the point of view that if this was your own money, how would you do it? And then another good thing on top of what we do through our venture studio, and I don't do it as an angel now, I'm going to start doing with the VC now that VC is starting back up. Done 3 investments out of that, and we're doing the next close. Is whichever deal then we're sort of going for, we are saying, look, we've got our own money invested in it, so I can't bullshit you, right? Because I wouldn't put in my money if I didn't believe in it, right? And because I've put my own money, that means I believe in it. That means you can trust me.
And you also mentioned the New York Times Weekly, celebrated you as 40 under 40. How was that experience like?
Yeah, that was actually really strange. So I didn't know. I just got an email saying I've been nominated. I ignored it. So I think I got this email in September time, right? I've been nominated, and I was like, this is surely a joke, like someone's just messing around, fine, whatever. But I was like, 40 under 40, like, that's too big. I've just turned 24 like last week, right? And I was like, 40 is like, so far away. So I was like, fine, whatever. And then December comes, and they were like, by the way, you need to come into New York. You've been selected. You're actually the youngest person, so we're going to put you on the cover and everything. And I was like, really, me? And it just happened so out of the blue. I didn't even realize it. And I was like, I will very with a lot of gratitude humbly accept it, and thank you very much for whomever it was that decided to nominate me, and the judges who were judging, and they felt that I was deserving of it. So massively appreciated. But I think there's a funny dialogue that is in Three Idiots, where Amir Khan says, a lot of people they try and chase success. Don't chase success. He says, like, Kabil bano, success will come chasing after you. So don't try and chase just the numbers, try and chase the aspect of being better, and then success will come behind you. Right. So my focus has always been just focus on what I'm doing and providing value and being better than the man I was yesterday, and then success will come itself.
I think that sums up our kind of religious beliefs also, that karm kar phal ki ichha mat kar. So just work hard, and I think you'll get the success all you need. And congratulations to you on being nominated and then winning as well. But then we talked about how do you raise money. So what these checks are like, how small they can be, and if someone from Indian diaspora or NRIs are looking to invest with you, how can they do that?
Yeah. So the good thing with us is that we have three arms of investment. We have our venture studio, we have the VC fund now for the Indian diaspora that we invest in across UK, US, and then we have our multifamily office. So we, the check size we invest ourselves and allow others to invest with us from different stage to stage varies between 25K to 10 million. So as long as you can put up a $25,000 check to a $10 million check, and you come into that bucket, that works, right? So it depends on which stage you want to come in. Now, a 25K check wouldn't work as a family office check, right? But it would work in the very early stage of a early pre-seed seed company, where they're accepting to take that, right? Where we create an SPV. For those who don't know, SPV is a special purpose vehicle. We almost think of it, create a pool. So rather than on the cap table there being 25 different names, it's just one name, and all the people are inside, almost like a little fund of itself, right? For that one particular investment. Right. So we can sort of enable that. So in the venture studio, the focus is, average, round side would be around 500,000 up to sort of 1 million. And, off that, we always sort of try and do 200K worth with ourselves and with our sort of co-investors. Right. So trying to sort of cover 30 to 40% of that. In the VC fund that we're setting up, the round size is for sort of seed plus Series A rounds. You're usually sort of looking at $2 to $10 million round, within which ourselves to our sort of partners will aim to cover about 500 to 1 million, right? So targeting about 5 to 10, maybe 15% of the round, unless we can get something really, really big. And then on the family office side, if you're a family office and want to allocate, I think game is very open field there, because that's when there's a lot of strategic money, right? You're, rather than just focusing on the number side, if you want to take the whole round, cool. There's families who have no issue putting like a $20 million check and taking the whole thing, right? So but then that becomes a lot more strategic of how are we plug and playing this into your existing portfolio? How are we sort of adding value into that? So yeah,
That kind of covers how do you raise money. Now, my second part of the question was, how do you invest? What kind of startups do you select? How do startups approach you? I'm sure that, being there in so many events, you will get like 10, 20 startups per day trying to, raise from you. So how do you select from those pool of startups?
yeah. I wish I only got 10 to 20. That would be a dream scenario. I mean, London Tech Week just wrapped up this week, and between Monday to Thursday, I had 280 messages and connections. The 10 to 20 would have been an absolute dream for my team. And I sent into the group chat. We had a group chat on WhatsApp. I was like, by the way, guys, I just put the screenshot of the number, and they just went, they started sending memes of like, oh, I'm dying, that kind of stuff, because they were like, they know now the next month is going to be brutal on due diligence calls. But how do we select startups, right? What do we sort of look at? So in the 3 different stages, we look at 3 different concepts. I'll try and go one by one. So in the venture studio side, when we're investing in pre-seed and early seed companies, most of the time, these companies are pre-revenue and they're intra MVP, so they don't have much to go for. They have sort of like an early version which validates what they're building, and they have some way of showing there's demand for what they're building, and they might have some LOIs and contracts. So what do we look at that sort of point of view? Well, the first thing we look at is the technology, right? So we like backing, protected IP a strong moat technology, right? So I don't want to back another CRM system. Why? Because there's tons of them already out there. Show me that you're defensible. Show me that if I have $1 million in my pocket, which, more than 100,000 people have globally, or probably more than that even, I can't wipe you out of the market tomorrow. And here's why, right? So what is your defensibility within what you're building, right? The second thing within that is then also looking at the market itself, right? Which market are you in? One, do we understand the market? And second, is it a growing market? Markets like, entertainment tech, they had a real, sort of slump over the last 10, 15 years, and they're now sort of coming back up with the rise of AI. So you need to figure out, which sort of markets are you sort of looking at? Health tech, for example, is now massively on the rise. Everyone is looking at health tech again. Right, but there's certain industries, which are, going down, and need to sort of say, does this make sense? And how niche the product is itself. So looking at product itself as well, right? So we almost sort of look at it as like a 4 components plus 1 kind of thing. So that the product itself, product differentiation, uniqueness of the product, in the sense that I don't want to invest in something which is, especially in the AI domain, right? Because that's the domain we play in. I don't want to invest in something which is 2% or 5% better than what exists, because the speed at which AI is changing and growing, they would be, again, wiped out of the market in the next 2 to 3 months. So I want to look at something which is extremely innovative, which will last the test of time. And, or, if not to that sort of extent, we can have first mover advantage, or really sort of be able to grow it. Again, comparing that to the moat again, we'll be able to grow it because we have that uniqueness, either from the founder side, or the team side, or product side, or the market side, right? And then that leads into the last thing without the plus 1, is the team itself, right? So who are the actual guys building it? So we always like to back second-time founders, or founders with executive experience. The reason we say that is because the startup market, as you know, is brutal, right? When the startup slump comes and you're getting no money, and you've not been earning for a few months because you quit to sort of make it work, a lot of people go like, man, I can't do it, I'm going back, right? And we don't want to have those founders who are like, can't handle it, leaving it, let the VC money burn. So we want to be with guys who know what it takes to build. They've been there. They know the troubles. They know what needs to sort of be done. And having that sort of executive expertise in what they're building. And oftentimes I see, nowadays, people building because they were like, oh, I'm really interested in this thing. Great. And sometimes it will work, but 99% of the time it doesn't, right? So if you've always been an investment banker, that's all you understand, that's your product side, and that's all you've been sort of looking at, and then you go, oh, actually I'm going to open an ag tech company because I saw this movie once, and they had and I'm like, but you have no connections, you have no like industry knowledge, right? No one in the industry knows you. So understanding that, and then what sort of board of advisors, and this is part of the founding team as well, has come on board. One of the biggest sort of telltale signs of how good a product potentially will be is who is coming on and adopting it early doors. So if I see your board of advisors are like guys from FANG, right? So FANG, for those who don't know, Facebook, Amazon, Netflix, Google, right? And I'm seeing these guys are sitting on to your board of advisors because they believe in it. Perfect. These guys have been techies for 10, 15, 20, 30 years. And they're seeing something that's a clear validation for me that there is something here, right? Either within the founder or within the product, and I need to go for it. And then the plus one is sort of the FOMO thing that I talked about, right? VCs are just big on that. So who else is coming in as an investor, right? So we don't lead rounds. We are usually a follow-on. We've done co-lead in the sense that if someone is matching the same check, we will co-lead with them. But who else do you have the ability to pull in, right? So that's on the venture studio side. On the VC side, it's relatively similar, but with a few then different changes. So then this was pre-seed and early seed. With the VC side, we look at seed plus and Series A. Now, when you graduate from early stage to now the sort of middle stage, coming almost to the growth stage side, you need to have a clear understanding of your product market fit. You've understood it. You've done a pivot or two. When startups come to me, they're at Series A and they're like, we've not done any pivots. I don't see it as a good thing. Right? You look at YouTube, for example. I don't know if you know, YouTube started as a dating site. All you were meant to do was upload your video and then, a suitable companion would come in and then do that, right? Amazon started completely different. Like everything started like that, right? So they've done a pivot. They, understand their price validation. They understand their market, and now they need scale capital to expand in certain parts of the business, and they have a clear go-to-market in that. So that's then we start looking at it from that perspective. And then also, definitely also do that in the early stage, but very, very accurate knowledge of how the money would be spent. In the very early stage, you have to take the best guess, but after you've been operational, let's say for 2.5, 3 years, you now should have a very good idea of how your dollar is being spent and why, right? And founders who aren't able to justify that, again, they don't fit that. And then the last thing for us, obviously, part of what we look at in the VC side is having one Indian origin founder. And, that's just part of our thesis. Finally, going on to the family office side and what we look for there things change slightly. So that's when we start looking at very much the numbers game, right? And where in the next sort of 3 to 5 years we can exit out. There, no longer the bet is looking at the 100x's. There is this a bang on 5 to 8x to up to 10x, right? Because the company, when it's getting to the family office, is already sustaining or clearing around 100 million. Now, if I say to a family that I will bring 100 million to 10 billion, they'll what is this idiot talking about, right? Because how many companies go, through that in that sort of stage? Like pretty much none. So then it's much more of who is going to acquire this, what pipeline contracts are going, which ones are coming up, and what is the value add for this particular family or this particular startup to be embedded as part of this family into the portfolio. All right. What are the cash flows like? What is the EBITDA burn like? How much are they burning and why? How do we strategically change that? So that's the sort of the conversation. Then the conversation shifts really much. Go to market and founders are still, yes, big part of what they're doing, but it shifts a bit more on the fundamental side into what we're looking at.
Anmol, I think as a VC, everyone is investing into AI. What do you make of it? Is it something like a trend, or is it a long-lasting trend, or let's say, to kind of differentiate between trends and long-lasting industries?
Yeah, I think it's one of those things. If I was to draw a Venn diagram, it sits in the middle of both, where it's definitely a trend and also long lasting. And the biggest thing to sort of compare to the guys, who've been around the industry for a couple of decades is the internet, right? So when the internet boom came in the late 90s, a lot of companies were everything.com, right? And then that wave crashed massively. But we don't say, what happened to the internet? The internet is still around, right? So I think there is that wave where a lot of guys are, and this happens in every trend, every wave, every whatever. There's a lot of bad actors, right? And I think 80 to 90% of these guys will be wiped out, which is just what's going to happen. But I think AI is here for the long run because we're far too integrated from the SME side, from the mom and pop sides, all the way up to the corporate side. Right, we've seen integration from the likes of, the biggest of the biggest companies like your Googles and Metas and Amazon, all the way down to the smallest sort of shop cleaners and, to the education system, to the schools, right? So even in schools now, the curriculum has changed where they're teaching kids in secondary school and primary school about AI, machine learning, and how to sort of do system engineering and build these kind of technologies. So I think it's definitely here to stay in the long run. On the startup side, what I'm seeing, I think there's definitely hype cycles. Initially, it started with I say initially, from what I remember, the AR VR cycle, the NFT blockchain cycle, and then the GPT cycle, now the agentic AI cycle, and it's going to go to something else, right? So trends come and go. That'll always be the case. But I don't think this is something which is like it'll come and go. I think it'll actually become like the internet, right? So, for example, you don't ask a startup nowadays, like, by the way, do you use internet? They go, what the hell? Of course I do. Right. So I don't think it's going to be a question in 10 years time of like, oh, are you an AI startup? Because they'll be like, well, of course, like I have some sort of API or some sort of integration. Of course, it will be if you're an AI first or a wrapper AI company. And what I mean by that is a wrapper AI is you're using this AI node, this API to enable faster, smoother operations within your work. So again, if I go back, to a hospitality or cleaning company, right? You're using AI to see or smooth your process of bookings, right? So before it would be someone would dial up and you'd write in a notepad, and a lot of companies still do that. Now they're booking in, it's going directly into a CRM system. CRM system is loading, is having everything read up, and it's managing your calendar, your space, sending the outreach directly, right? And the data is logged back in, and then that's getting transferred directly to your accountants. Everything is moving in a lot more swiftly. But that's not a proper AI first company. They just used some sort of API to make themselves more efficient, which is great, right? Which we still need that. An AI first company at its core is a machine learning development company whose whole process is to utilize this data that it's capturing and unlock certain doors of innovation, right? Which is the likes of your DeepSeek and your Perplexity and your OpenAIs did that. So that will be the question, I think, going ahead of, which are you?
I think to kind of sum it up, what we have discussed so far, I like your thesis. I like your knowledge about how trends are shifting. And as an NRI, I would be really keen to discuss more about the opportunities that you have currently. And I hope so do our audience, and they can reach out to you. I'll leave the details in the description of this podcast. I'd like to move on to a new kind of section wherein I'll share some kind of questions with you, which and you have to kind of respond a bit spontaneously on it. And these are more like macro factors or some of the industry trends that you see, and I just want your view and opinion on those things. Yeah. So the first one is like, the investments obviously are hampered by macro factors. And what do you think of Trump and his policies and his recent feud with Elon Musk?
I think it's man, it's very interesting. I think that's the apt word I can use, because I don't want to use a different word, because I have a lot of American guys as my LPs, and I don't want to piss anyone off. But I think, well, there's a whole economic term behind Trump now, which is called Trumponomics, which is literally looking at the behavior in which Trump is acting and why it's resulting in the things it is, and it's being able to move the market in the way it is. I think it's part genius and part very erratic, in the sense when we look at the trade deal, right? And this was something Obama wanted to do. This was something Biden wanted to do, right? But no one was able to really bring people on the table together. I think what almost Trump did, and I was with Kevin McCarthy, right, the 55th Speaker of the House, a few weeks back, right, and he was sort of saying this about the strategy, where his whole thing wasn't to, not to speak for himself, I think this was just my understanding of what he was saying, was he wanted to bring everyone back to the discussion table. And the only way to do it was just ruffle the feathers to such an extent where everyone goes, whoa, 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 what the hell is going on? I need to come. Right. And that's exactly what he did. And France came flying in, and UK came flying in, and India and Russia and Ukraine, and there was within 1 week at the exact same oval table, He'd done like 7 or 8 different interviews with some of the biggest presidents and world leaders. And that was the whole mission behind it. It was to be so moving, the market just goes, what the hell has happened? I need to go speak to him. And then they could start negotiating from there, right? You throw the worst out there and then you start bartering down to what's reasonable. So from that point of view, I think he's a bit of a marketing genius, and I think his team knows what the hell they're doing. From the general consensus of what's happening with Elon, and him, it's very hard to say. I think at a certain point, I think Elon is right, because the whole reason he was put into Doge, right, the Department of Governmental Efficiency, was to make the overspending, which has been the root cause of why many are saying US in the next 10 to 15, 20 years will be a depleting economy, was because the government debt is too high. Now, with the new bill Trump has passed, he's just added $2 trillion to existing debt, which the US government already has, which rightly so made Elon go, what the hell, dude? We've been talking about this for the last year. I was championing you in my rally, spending over $250 million to talk about how we're going to go do cuts. And you've gone ahead and just done the complete opposite. Now, again, I don't know if this is meant to be a scare tactic or if this is meant to be something with deeper behind it. But I think it's very erratic. So I think part of the advice, so a lot of family offices, earlier in the year were like, this year, we're just going to watch, right? We're not investing, or like we're going to be very opportunistic. And a lot of my LPs pulled out as well. And it was really frustrating because they were like, we're just too unsure. This guy, says something and the market depletes 30% and then says something else and the market goes back up, and we just can't take that risk, right? Especially when you've got a few $100 million in your bank account, right? It's not like you're dealing with a couple quid. So I think from that perspective, you need to be, one, very careful, but also I think this year is the year, if you're a smaller investor or sort of medium size, I think being cash heavy will serve you well, right? Where markets, and the thing with the market is the market will always overreact. That's the standard nature of the market. It has happened from day one, right? Because there's too many followers in the market, right, who don't understand the market but will see a signal and will go with that. So when you see the market bleed, pick it up, right? And when you see the market soar, sell it. That's just been the general principle. That's the Berkshire Hathaway 101, right? Charlie Munger sort of talked about it for years and years before he passed away. So from that perspective, I would say for Trumponomics, be a bit more cash heavy, but also be very eye open and careful of who is he hanging around with, right? And this was this picture as Trump was getting inaugurated, or sort of winning his last sort of tours towards the end of December, early January of this year, and there were 3 or 4 CEOs with him which have seen the most growth. Obviously now the things have sort of come back down, but one was Tesla, so Elon was with him. The guy from Nvidia was there. I forgot his name. The lady from AMD was there, and the CEO of Palantir was there. And all 4 of these companies this year have been on an absolute blast, right? And obviously things have sort of slightly come back down, but I'm very sure they will go back up, right? So notice who Trump is hanging around with. What is he sort of trying to doing? He drops a lot of clues. So if you can be one step closer to him, and the thing of you're 7 connections away from anyone. I think at my stage, I'm about 3 away from everyone, but not everyone has that access. But even if you can get to 6, right, or a 5, you will get a better understanding of how things are moving, and you can then make that 1% better decision, which will, be worth everything.
Well, that's a good angle to look at it, and yeah, I kind of really like it. Nice. Next question, quick one is, if the founder is not from IIT or IIM in Indian context, you're raising, you're working with a lot of Indian founders. If he is not from IIT or IIM, do they still have shot with VCs?
Yeah, of course. I mean, look, it's the same representation in the IIT, IIM, right? Especially when you look at the Kharagpurs and the Roorkees, right? Of course, they've produced the best engineers, but I don't think the best engineers are the best founders, which is where people sort of go wrong. The best engineers are best builders, the best CTOs, but they're not the best founders. And funnily enough, when you start looking at these trends, you start realizing actually you need a businessman with them. So if you haven't gone there and you think, oh, I failed, then I think it's the mindset thing, right? How good is your connection? How good is your ability? It's the same thing that could be applied into, the US side or the UK side, right? I see so many guys coming here and trying to chase that MBA from Oxford, Cambridge, or Harvard, Stanford, right? I don't think it matters. Obviously, you need to have some sort of degree of being able to say you have certain education which makes you better if you're in the early stage. But if you're like a founder who's in his 40s and building, who cares, right? What has been your last 20 years like? What is your network? What are you building now which has got to do with the last 20 years of your hard work? And if that makes sense, great. But if you're a new founder, I would say education, fine, but try and get as much experience as possible, right? So I have a few cousins who are currently in university, and they're like, I'm gonna do this course and this more course and this additional, from whatever website, degreekaro.com and whatever shit. And I'm like, dude, forget all of this. Go find a startup and just work for it. Like, literally find 2 or 3 startups where you can start learning actual things, because you don't learn how to swim by reading about swimming. All right. You got to go jump in. You got to drown a little bit. You got to splash. You got to make some noise and figure it out. All right. You're not going to learn it by looking at it online. So yeah, don't worry about that too much.
Indeed, and even the education system is shifting from degree-based to experience-based. We have seen those, and the more experience you have, the easier it is to get a good job. So yeah. The next one is, why do VCs ghost startups after showing some interest?
That's a very interesting question. I think, and I'm partly guilty. That's why I laugh. I think sometimes when you're, looking at so many partly it's like you're good, but you're not good enough. So you'll go, you're good, and I want to see where things will go. So it's not like we will go, so we'll go on monitor mode where we're like, you just about missed out, but I saw something which has made me intrigued, and I want to continue to sort of see that. Sometimes it's just like, dude, I'm just too busy. And sometimes it's like, you're not getting the hint, and I don't want to be an asshole, because if we become the asshole, we get called out by everyone. They just go, founders have this like massive entitlement that you owe me a feedback, you owe me this, and you owe me like, all this sort of conversation. I'm like, dude, no, you want my money. I looked at it and it's a no. I'm giving you the feedback out of the kindness, and I want you to do well, but I don't owe you anything. And there's been too many sort of arguments and LinkedIn bashing of VCs where they go, it's better to just stay quiet. So I think it's a culmination of those things.
Well said. With that, I'll just ask one last question that kind of sums everything up, the all 1 hour discussion we had. How much of startup success is luck?
Oh, I think a big part. I think, and part of luck is you create your own luck as well, right? So sometimes you have very small opportunities where the little yes and no can make all the difference, right? And so I think being lucky is also a trait that you need to master. The funnier quote that I made, right, and this was for me, was, I don't know how it works, but the harder that I work, the luckier that I get, right? And I think that also applies, but pure luck also itself, sometimes you're just in the right room at the right time at the right place and things happen. But how did you get to that right room? That's also a question, right? If you weren't deserved of it to begin with, you wouldn't be there. So yes, now I end up in rooms where I have met royalty, I've met sports stars, I've met celebrities, I've met VCs, I've met the biggest of the biggest private equity companies, leaders of countries. And yes, I'm lucky that they came in and I had the conversation and whatever, but what did it take to build that luck to begin with? So I think it's still 2 parts of the equation, but I think it's luck is still definitely a big factor.
I can agree more, and I do say, like, to get somewhere, you have to leave somewhere. So with that part, it's time for us to leave. Thanks a lot, Anmol. That was really nice talking to you. Thanks a lot, and I really appreciate taking out the time from your really busy schedule. And if I hope some of the NRIs are watching this podcast or listening to this, they can reach out. Thank you so much.
It was my extreme pleasure. And anyone who, wants to contact me and have any questions, please feel free to do so. It might take me a few weeks to get back to you, but I'm always very keen to speak to and meet interesting people, especially of the diaspora, who are building cool things or who want to back cool things. And thank you again, Gaurav, for having me.